Hello and welcome to the CNBC TV18's Mumbai Newsroom. I'm Sonal Bhutra and you're watching Mutual Fund Corner. And today we are going to discuss something very interesting. How can an investor invest in international stocks and bonds? But before that, let's give you a background. We have seen that international funds have been in focus. Back in the day, in February, SEBI asked Indian fund houses to stop investing in international funds, which are basically stocks or debt instruments of companies registered and listed outside India. This is because that $7 billion limit was hit by mutual funds with respect to international investments. In June, this rule was relaxed. SEBI went ahead. They asked funds to resume subscription and make investments in overseas funds and securities as well. Overall limit of $7 billion was still there. That was fixed for international investments. ETFs have an additional limit of $1 billion. There was a sharp decline in global market stocks, and that's the reason why this relaxation was seen in the month of June. But not all international funds, they were able to use this limit because most of the schemes did not see this redemption, so to say, after this relaxation was made. So generally, trying to understand today with our guest, how can one take international exposure through fund of funds? So let's discuss it with Feroz Aziz, who is joining us from Anand Rathi. Feroz, good afternoon. Always a pleasure speaking with you. Thank you so much for joining us. And that takes me to the first basic question, right? What is a fund of funds? What kind of investments do fund of funds offer? And what can the investors know about this scheme?
Good afternoon, Sonal. If a person wants to invest in a fund of fund, it's very critical to understand what it is. In fact, SEBI has made life very simple for even a retail investor. The name itself implies its strategy. Fund of fund. It's a fund which invests in other funds. So that's why it's called a fund of funds. So that's point one. Point two, if you want to go global, for example, fund of funds can actually be of 5 different categories, not just the international fund of funds. So you can have a domestic fund of fund, you can have an asset allocator fund of fund, you can have a gold fund of fund, you can also have a fund of fund which invests in ETFs. So there are 5 different categories of fund of fund. If I have to limit my discussion to international fund of funds, so you invest sitting here, and the fund you have cut a check to is subsequently cutting check to 2, 3, 4 other fund of funds. That's why it's called fund of funds. So for professional entrusting money to other professionals to manage it. And there's, of course, going to be 2 layers of fee for it because there are 2 professionals involved or two companies involved. That's the basic, and I think it's basic enough for most to interpret.
Absolutely, that really helps. But Feroz, there's been a lot of worry amongst investors. I briefly spoke about what were the restrictions which were put back in February. Of course, it was relaxed a little bit, but is there a reason to worry when it comes to investing in international funds? What should investors look at? What are your thoughts?
See, Sonal, I can tell you as an investor myself, you should never be worried if they restrict you to invest. When there's a restriction on you redeeming money is when worry comes in, because there are a million different alternatives to invest. So worry in terms of capping an investor investment purchase at an industry level should not bother any of them, to my mind. If they say, I'm going to restrict you from redeeming the money you've invested, there's definitely signs of worry, and that's the genuine place where you will worry. That's point one. Point two, why does a regulator do something is very, very important, because every action of regulator has a message in it. You can read between the lines and go with the principle of it, not by the letter, but the essence of the regulation. If I read this regulation of capping international equities, was because of 2 big reasons. One is because RBI has permitted each individual to remit $2.5 lakh. $2.5 lakh is upwards of $1.5 crore. You can do that yourself and invest directly. Why choose a mutual fund route? If you choose a mutual fund route, the regulator is telling you that you're circumventing that cap of $250,000 per financial year per family member. That's a very generous limit. So mutual funds were using, quite a few people were using mutual funds to circumvent that 2.5 lakh limit. That's point one. Point two, regulator also noticed that past performance is being bought into, like NASDAQ funds. Past performance was one of the key reasons why NASDAQ ETFs got thousands of crores. And then you see subsequently NASDAQ having fallen 30% from its peak. So basically, Indian investors still are a maturing lot, and they may look at past performance to make judgments rather than fundamentals. So restricting it, I think, is a good idea from a regulator standpoints, and no worry for anybody whatsoever.
So point taken, no need to worry if there are restrictions. They are put in place after some thought. Of course, point taken there, Feroz. But that, of course, takes me to the next question in sense of how can one get an exposure to international markets through fund of funds? Because that is something that we are trying to focus on today as well. A less known category, right? So what to do in this case?
So there are some asset management companies who've still not breached the limit, and they are accepting money. There are totally 49 fund of funds which invest overseas, out of which 26 of them are still accepting money. So that's the universe which you can focus on to invest internationally as a retail investor. That's point one. Point two, when you invest internationally, it's my suggestion that you have to understand that market, not just look at performance. I have met several HNI and even ultra HNI investors who invest in an S&P ETF, but they don't know what's the earning of S&P for the last 1 year. Right? So if you don't know the earnings of those 500 companies and you still have money as an HNI, that implies that you're not doing enough homework. You're just buying into the story of diversification and buying. So point one, 26 funds accept. Now, when you wish to buy any international market, try and dwell deep into it, or at least get your distributor to dwell deep into it. The Nifty, the S&P 500 PE today is 21. In June, it was 18. Most people who invest don't even know the earnings. They don't know the PE. So don't go by the herd. Do your homework and choose one of these 26 funds if you want to get global exposure through fund of funds. And 10 asset management companies are accepting it. And that's a reasonable universe for somebody to pick one fund from or two of them from.
Oh, yes, it is reasonable. I would say there are a lot of options going by the numbers that you just told us. When we talk about investing, when we talk about, earning returns, what really comes to everyone's mind is what would be my post-tax return, so to say, right? So in this case, fund of funds, how do we talk about taxation? How are fund of funds taxed?
Yes, Sonal, what you said is so important because what you get into your pocket or your bank account more so is after tax. So making sure that if there is any tax disadvantage, trying to make it neutral, tax neutral, and then compare your alternatives is the most mathematical way of decision making when it comes to your money. So there is a tax disadvantage. Let me begin with that statement and I'll substantiate what is the tax disadvantage vis-a-vis a domestic fund of fund or a domestic equity fund for that matter. For equity funds domestic, which is a very popular phenomena, you have 10% tax after 1 year holding. On both the counts, there's a disadvantage to international funds, all of them, irrespective whether they're fund of fund or feeder funds or just normal funds managed domestically. What is the disadvantage? You have to wait for 3 years for them to slip into long term, not 1 year anymore. And when they actually slip into long term, after 3 big years of wait, you still have to pay 20% tax. But then you get one advantage, which is indexation, which is 4 to 5% indexation can be assumed. So there is a tax disadvantage because your waiting period for an international fund is no more 1 year, like the domestic funds. You have to wait for 3 years. So if you bought a Nasdaq fund and if you made money and if you got the entry right, you may also want to exit that fund, but you will be taxed at marginal tax rate if you can't wait for 3 years. So that's one disadvantage. International investing across different categories of funds exists.
Interesting. And that is an important point to highlight, right? Because while we talk about returns, as you said, post-tax returns, what actually go in your bank account really make the most amount of sense. So generally trying to understand how are fund of funds different from mutual funds? Can an investor invest in these fund of funds by opening a demat? Are there more regulatory differences between the two?
See, Sonal, actually, there is no regulatory difference, or logistically, the pain or the ease with which you can invest is identical for any other mutual fund. Okay. Only subtle difference is in the strategy, not in any client-facing documentation. So, do you need a mandatory demat account? The answer is no. Can you invest in physical form for a fund of fund just like you invest other mutual funds? The answer is yes. Do you need a trading account? The answer is no. Those are not mandatory. Those are two forms of purchase which are available to domestic equity funds or debt funds, and the same rule applies for fund of funds. The strategy is different, that the fund manager you're giving the money to is not managing it himself or herself. He or she is choosing another set of fund managers who are going to do that task for you.
Okay, so not very different in terms of regulatory terms, easy to invest as well. Of course, going by the way mutual fund investments really are. Firoz, I would like you to hold on for a bit. We just have to get into a quick commercial break and we'll continue this discussion on the other side. Stay tuned. Welcome back. You're still tuned into Mutual Fund Corner on CNBC TV 18, and we still have with us Firoz Aziz, who's the Deputy CEO at Anand Rathi Wealth. We have spoken about taxation, a tax disadvantage when it comes to fund of funds. Firoz, if we talk about the cost of investing in a fund of funds, what do the numbers look like?
See, the number looks like an average of little over 175. 1.75% or 175 bips. That's the aggregate average expense of the category on the international side. On the regular option, if you're going to buy a direct option, that's going to marginally reduce the cost, not as much as a domestic fund. But in the international fund, there's a smaller difference in direct and regular. So 1.75 for equity. Is the expense. See, what happens is you have to be very sensitive to expense depending on the return you expect. In the debt funds, for example, if you're going to be earning 6%, and if you're going to pay 1% as cost, that's a very large percentage, 1% on a base of 6. But if you're going to pay 1.5% also on a base of 12%, which is what you expect, that's still a small number. So always be sensitive to cost with respect to the expected return rather than just the absolute number. So on the debt side, I don't like even paying 0.1% or 0.2% because my return itself is a small number. I can't spend 1% to get my best fund manager. So that's why I see 1.75 is not outrageously high. And there are some caps on double cost as well. That's why they've been restricted.
Point taken. Then, in that case, what would you advise the investor to do? How much of an exposure should they take in fund of funds?
If you just look at international fund of funds, I would say exposure cannot be one size fits all. It is not something which everyone should invest in. That's my firm belief, because India is one of the better destinations from an investment standpoint. If you have global goals, if your objective is to send a child abroad for education or whatever purposes, global tours are a part of your goal list or aspiration list, then definitely having an international fund gets you that dollar exposure, which is very critical. If you don't have goals attached to international currency, you can live without it, at least for the next 1 year. I personally think that India's GDP growth, which is expected to be above 7%, which is greater than the long-term average of 5.8, which is a great number. Infrastructure spending, which comes from government's income, 30% increase in taxation, both on the direct side and the indirect sides, very clearly say, and the domestic flows being so robust, we will continue to stand out like we have stood out over the last 1 year, which is very unusual. In the last 20 years of my working career, I have not seen India shine so well when the globe is in trouble. So going outside for the next 1 year is not as meaningful as it could have been maybe a year back, year and a half back or so.
Yes, absolutely. We've been talking about how Indian market has been decoupling from what we are seeing in the global equities as well, right? So if you can give us a sense of how can retail investors in that case invest directly in global ETFs? You mentioned them. There is the LRS route also. Explain to us in that case.
Yes. So, Sonal, like I told you, that LRS, which is the abbreviation to Liberalized Remittance Scheme, was started, if I'm not wrong, somewhere in 2004, 2005 with $25,000 limit. Now it is expanded to $2.5 lakh every financial year per Indian resident. So it's a very large limit. So you can use several technology platforms which are available today, which were not available 10 years back. When we used to use for our clients LRS limits, we need to have had a tie-up with a bank in Singapore or Dubai and then do foreign investing way back in 2009, 2010. But now sitting in the comfort of your house, you can use different apps. I can name a few without soliciting business for them. Grow, InMoney, all these apps actually help you access ETFs outside, stocks outside. You can do your own research and buy them for very, very little amounts, as little as $500,000 as well, depending on the platform. So explore them. I can only create curiosity for you to go a step further and do your homework. This is not going to be conclusive information for you to take the plunge, but definitely it's possible with reliable platforms available for you to invest globally.
Okay, so creating curiosity, that's the idea anyway, right? Everyone should do their own homework when it comes to investing in whatever asset class we are talking about. But Firoz, I have to ask you, because you spoke about taxation disadvantage here, costs being in place as well. What is your overall idea when it comes to international investing? What do you advise any investor who comes to you and says that, okay, I have this much amount of money, please invest it in an international stock via any mutual fund?
See, Sonal, I'll be very honest with you. See, understanding international markets for even a wealth outfit like ours, who manages 8,000 families, needs at least 25, 30 research people sitting globally. If Indian research requires 81 member product team and research team for me, understanding the globe is like I need to have 300 people doing that if I have to do it in full capacity. That's point one. So point two is that going international has to have a lot of homework. So what I recommend to people is when there's a very strong compelling case where you touch anything internationally can become gold, at that point in time, you can still have an exposure. For example, like June this year was a good opportunity because S&P's earnings per share, which most investors also don't know, is 191 as of 30th of September for the previous 12 months, which makes the PE of S&P down to 18, which was the least it touched for 4 years. At that point in time, somebody asked me a question, I would say if you're getting the top 500 companies of the US at an 18 PE, with an 8% growth done previous year, I would say go with an ETF of S&P 500. So it's going to be very, very tactical. It's never going to be strategic. It's going to be dependent on relative ease and relative attractiveness with India. To my mind, India is far more attractive. 11, 12% on Nifty is possible. 3% dollar depreciation is something, dollar appreciation is something which I would provision for. So 8, 9% dollar returns Nifty can deliver very easily over the next 3 to 4 years. So India is what the focus, unless there's a specific need for global and some compulsions at a client level.
That's definitely an honest view, and that is exactly the reason why we had you here, Firoz, today. Definitely gives a perspective to investors as well, because there is, of course, a lot of homework needed before there is any sort of investment in international funds or international investing via fund of funds. Thank you for your perspective. Thank you for joining us today on this masterclass, and hope to be speaking to you very soon again. With that, it's a wrap on this edition of Mutual Fund Corner, but do remember to email us your queries and we'll address them with our experts. Stay tuned for Closing Bell to take you through the last hour of trade.